I think the key thing is if you look at liquidity right now, it's actually improving. Credit spreads are tight. Equities near all-time highs. Lending for most industries actually is okay. So that's not in the environment where we see a recession
but
yet.
Hiring by U.S. companies, which Rosenberg thinks is the issue, is not a supply-side issue, according to him?
Yeah, so hiring is slowing, and that is a concern. That's why yields have moved down. We've been bullish on bonds. We're out of consensus. Actually, October 23, we upgraded our U.S. government bond view, and 10-year was about 5%. So we like this rally, but we think in the short term it may be a bit overdone. The key will be the data. That's what's going to determine it. Yeah. And if we see employment drop sharply, hiring rate is key. Also, the employment data and weekly jobless claims. Those are the type of things you look at. But for example, weekly job claims recently started to pick up again. Yeah. But the data is mixed. But what we're not seeing is things falling off a cliff. And if you think about the employment data itself, half of the increase in the unemployment rate was the increase in the labor force, not pure layoffs. That's a little bit different than prior cycles. So history doesn't repeat it often. You know, it rhymes. That's what we're looking at.
Do you have a problem with how richly valued these markets are, regardless of however you slice it, whichever valuation metric you use? It looks elevated. It looks priced for perfection. And what could be the catalyst for a valuation reset, and are we in for another volatility event? And what could trigger it off, Prashant?
Yeah, good question. I think in general, what we're looking from the equity side, what we said was by mid-July, we could not have one sector leading the returns for the market. Obviously, AI-related stocks, Mag 6 really leading the returns, not Mag 7, but Mag 6. And we need to see a broadening of the market. So we've seen that. So what's leading markets right now? The equal-weighted S&Ps actually hit an all-time high. NASDAQ is 4% below. That's important. If we did not see that broadening of the market, that plays into the recession call, right? If you're seeing financials, insurance, some of the industrial sectors all rallying, that's key, is that we have to pass the baton to sectors that are cheaper, that are trade below a market multiple, pay a dividend yield. So that's key, I think, in terms of broadening the market. Yes, there are parts of the market that were overheated that need a timeout. We agree. Is the same upside we had in equities there as we had a year ago, 2 years ago? No. But if we have a softer landing or no recession, generally rate cuts in that environment, stocks can outperform even bonds, and bonds outperform cash.
Well, hold on here, because look, you know, a fair number of people have traced it back and said, well, look, what happened to equities the last two times? Right, the Fed started a rate cut cycle with 50 basis points. First time they can remember was, I think, 01 recently, and then was it 17, I think? In both cases, when they started a rate cut cycle with a 50 basis point cut, a year out, stocks were down 30 or 40%. Why is it going to be different this time around?
Yeah, so agreed. So if you're talking about 2000 or 2007, you know, I lived through those cycles. I had more hair then. And the issue there is you definitely needed, the Fed cut late. The Fed, you know, if you remember 2007, I remember it well, you know, they started cutting, and then we had the rebound rally in equities, and then obviously we know what happened in 2008. It's credit. You asked earlier as well, what could trigger a major sell-off? It would be a credit event. It would be leverage in the system. Now, right now, yes, there's leverage in some parts of the system, but the banking system is pretty healthy. We're not seeing credit spreads elevated. So watch credit spreads. Credit spreads increase more than what we would expect. That could challenge that soft landing view.